It's Friday, 16th of August, and this is your Capital Economics Weekly Briefing. I'm Neil Shearing. David's out this week, but I'm delighted to be joined by Chief Global Economist Jennifer McKeown. Hi, Jenny.
Hi, Neil.
Now, so much for the dog days of summer. We've had a deluge of data and statements from policymakers over the past week. That's kept us busy, and we should pick through the bones of what we've learnt. In general, though, I think we feel more confident, don't we, in the view we set out a few days ago during the height of the growth scare, that recession fears are overdone. I think if you look back at the data, most of the activity data that's coming over the past week continue to suggest that growth has held up reasonably well. Okay, we had that soft industrial production print for the US for July, but that appears to be mostly temporary factors, we think, related to retooling at auto plants, Hurricane Beryl. The retail sales data in the US don't suggest that the US consumer is cracking. And of course, over here in Europe, we've had Q2 GDP data for the UK, which showed another healthy increase in output. So, taking all that together, what do we make of this growth scare? Has it faded already? Can we call time on the recession scare?
Yeah, without wanting to sound too complacent, I think it probably has. I was on holiday last week and I've come back kind of wondering a bit what all the fuss was about. As you said, these US retail sales data really looked pretty good. Sales were up 1% in July, even control group sales up 0.3%. So that bodes well for an acceleration in consumer spending in Q3. And initial jobless claims as well have fallen back a bit further last week. And that's a particular relief after the rise in unemployment, which obviously sparked the fears last week. And then at the same time, as you said, we've got the UK economy growing pretty strongly. And Japan too. We had a 0.8% quarterly rise in Japanese GDP in Q2. So it looks like things are going fairly well. Now some of the surveys are softening a little bit, to the extent that you would be really concerned. They're perhaps just pointing to slightly softer growth than we saw in Q2.
Okay, so perhaps the growth scare in advanced economies is easing. What about China? It's really striking, I think, that the markets fell out of bed on that one soft ISM manufacturing survey report for the US, and then followed, of course, by the soft employment report for the US in July. That created mayhem in markets, but we've had 6 months or so of weak data from China, the world's second largest economy, and investors have largely looked through that. So what's going on there? And is there any hope that things might be turning around in China?
Yeah, that's right. I guess the weakness of China has been a known fact for quite some time, and that the initial fears of a really hard landing in China around the property sector in particular have eased off. So maybe those weak data that we've been seeing are essentially more of the same. And of course, China has still been growing thanks to its ability to export. So we've not seen a really dire situation, just much weaker than growth would ordinarily be in the rapidly growing Chinese economy. The latest data, though, suggests that actually perhaps there's scope for an improvement now. July's activity and spending data were fairly positive. They suggest that growth has stabilised after Q2's slowdown. Industry has softened a bit after its fairly strong performance earlier this year. But the really good news is that the service sector, which is much larger than industry, even in China, saw growth edge up from 4.7% year on year to 4.8%. So some fairly positive rates of growth there. And of course, given that the PBOC has increased its policy support and, more importantly, fiscal support is still picking up in China, we think that we might be heading into a bit of a recovery in the second half of this year.
I guess the rejoinder to that, although things may be improving a bit in the short term, the rejoinder is that it's still really driven, isn't it, growth in China by the manufacturing sector and exports in particular. I know that your team produced a big report over the past week looking at global imbalances. A key finding there is that if you look at some measures of China's trade surplus and current account surplus, it's now as large as it's ever been as a share of global GDP. And obviously we have concerns that that's going to pull China into greater tension with the US in particular, up to and beyond the election this year. So that's certainly a risk worth keeping an eye on, even if the cyclical outlook for China might be improving. What about inflation? Because we've had a flurry of data on that over the past week, haven't we? What's the story on inflation? Are we still on this glide path back to 2.5%, or should we be concerned by, for example, in the UK, we had the inflation numbers edging up in July?
Generally speaking, actually, the latest inflation data have been pretty encouraging too. But perhaps starting with the US, because maybe that's the most obviously encouraging one. The headline rates dipped below 3%. And if you look at sort of the more timely 3-month annualized type measures, they, I think, suggest even more firmly that the disinflation trend has resumed after that scare that we had in the first quarter, or that hiccup. The US core rate of inflation's at 3.2% now, and in 3-month annualized terms, actually core CPI fell to a 3-year low of only 1.7% last month. So that's actually pretty much in line with the Fed's target already. So I think there's really a lot of reason for hope in terms of the US inflation situation. Of course, rental inflation is still much too high. It's quite surprising that it hasn't come down. That might be a bit of a concern for the Fed, but I think generally that might mean that it needs to be relatively cautious in the pace of loosening. But I think nonetheless it's fairly clear that some loosening is warranted given this inflation backdrop and the current high level of interest rates. The UK inflation data slightly less encouraging. As you said, the headline rate nudged up from 2% to 2.2%. But that's largely, like the situation in the Eurozone actually in July, that's largely about some unfavourable base effects. And actually, if we look at core rates and the all-important services inflation, that's come down pretty sharply in the UK. It dropped from 5.7% in June to 5.2% in July. Still too high, but an awful lot better than it was. So we're heading in the right direction.
We'll come on to what that means for interest rates, central bank policy in a moment. But let's talk a bit about Europe, because it's really striking, I think, when you look at the data, particularly from the labour market, that wage growth appears to be taking a lot longer to slow in Europe than is the case elsewhere. So over the past week, we've also had labour market data for the UK that showed unemployment actually edged down. Wouldn't put too much attention to that given the problems in the UK unemployment data. But the wage growth numbers were better news for the Bank of England. We saw those coming down. And of course, we've seen a pretty significant slowdown in wage growth in the US. It's taken a lot longer for wage growth to come down in the Eurozone, though. And I noticed over the past week, Germany's main union, IG Metall, pushing for another 5-6% wage increase for the coming year. So what's going on there? Why is it taking longer for wage growth to subside in Europe, and what does it mean?
Yeah, I mean, I think one of the problems with Europe and the labour market is that the labour market data are very lagging. So it's quite difficult to tell exactly what's happening. While in the UK and the US we have relatively timely wage data, for the Eurozone we're always looking back kind of a quarter or so. So that might be part of a reason. But I think notwithstanding that, it is pretty clear that Eurozone pay pressures have been a bit stickier. And as you say, even some of the very latest wage negotiations point to some possible cause for concern. And the ECB has highlighted that too. Now, it might be, it probably is, about the relative rigidity of Eurozone labour markets. Wage growth was slower to pick up as well in Europe, so perhaps it's not surprising that it takes longer to respond on the way down. But also a lot of wage contracts are set over relatively long terms. There's some lagging indexation to CPI. So all of these kinds of things mean that it is pretty likely to take longer for wage growth to come down now that it has finally risen.
Okay, so I mentioned earlier, we'll come back to what it means for monetary policy interest rates. What does it mean for monetary policy and interest rates? If we start with the US, I mean, that's clearly the most important central bank decision coming up over the next month or so. Is 50 basis points now off the table in September? We're back to a 25 basis points cut, do you think?
I think so, probably. We were never actually forecasting 50 basis point cuts. That always looked at a bit like an overreaction to us from markets last week. There was quite a swing, wasn't there, from predicting barely any reduction to suddenly talking about relatively aggressive cuts on the basis of what was not that much data. So we've really stuck to our call that the cuts will come in 25 basis point increments. We're still expecting the first one to come from the Fed in September, and we'll probably see another 25 basis points from the ECB as well in September, although there are those risks that we talked about around wage growth.
Well, what about other G10 economies? We've had several decisions, haven't we, over the past week or so from the RBNZ, a surprise rate cut there. Actually, our team were forecasting the cut in rates in New Zealand, but it surprised the market. How do other G10 central banks respond to Fed loosening? I guess the big one is the Bank of Japan. What are they going to do next?
Yeah, we were among the first to say that the Bank of Japan would hike interest rates in July. And we also correctly predicted its rate hike 2 weeks ago. Japan's in a very different situation to other economies, with interest rates starting at such a low level. And given that the bank has had so many problems in raising interest rates into positive territory and to getting inflation up, the relative stickiness of inflation there is actually a comparatively positive sign compared to what it would mean for Europe, for example. So it's pretty likely that the Bank of Japan is going to take this opportunity to continue hiking in October. But I think probably the window is very limited. And once the Fed starts to cut, the Bank of Japan probably won't be able to continue hiking into next year.
Okay, so big picture monetary policy outlook. What's going to happen to interest rates globally over the next 6, 9, 12 months or so, do you think? How aggressive can we expect this cycle to be?
Of course, there are risks around the economy and the extent to which the global economy will weaken in response to the previous tightening. But our assumption actually is that this loosening cycle will not be particularly aggressive, that it will be a normal cycle, with most banks, at least in the major advanced economies, cutting by around 25 basis points per quarter. We think that the loosening cycle is going to broaden as next year goes on, and that it will become really quite broad-based, one of the most broad-based loosening cycles, in a similar sense that the hiking cycle that came before it was a very broad-based one. And you mentioned the Bank of Canada and the Reserve Bank of New Zealand, where we've had good calls recently. We expect both of those to cut rates more deeply than financial markets currently expect, and that's largely because of the weakness in their economies, which is much more stark than that elsewhere, and particularly in contrast to the relatively robust economic outturns that we're seeing in the US.
Thanks, Jenny. That was Jenny McKeown on the outlook for the global economy, picking through what's been another busy week of data and policy statements. I'll link on the show notes page to the Central Bank Hub. That's the one-stop shop for everything monetary policy, where we put all of our forecasts, all of our data, all of our analysis. I'll also post a link to the piece on global trade imbalances that I mentioned we've just published. That's it for this week. Dave is back next week, when I'll join him to pick through the bones of another week in macro and markets. But for now, goodbye.
Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.